Live now to the Treasurer. We're taking you live to Canberra. He's reacting to today's GDP figures.
Since this data, some of the pressures on them and some of the pressures on our supply chains have grown. And that's been a consequence of rising interest rates, deteriorating global situation and, of course, high and rising inflation, which is primarily but not exclusively global and has some domestic elements to it as well, as the Reserve Bank talked about yesterday. The headline figures in today's national accounts are encouraging, but the details do confirm the pressures that are being felt by Australians and the pressures that are being felt in our supply chains in particular. Real GDP increased by 0.9% for the June quarter, and it was 3.6% higher over the year to June. This solid growth is welcome and it's broadly in line with our expectations, but the drivers of this growth were still narrowly based. It was supported by some temporary factors and a lot has happened since the end of June. The big contributors to this growth were household spending and exports. Consumption increased by 2.2%, contributing 1.1 percentage points to real GDP growth. And a big part of this story is the fact that people felt increasingly willing to spend on discretionary services in particular as we came out of that phase of the pandemic. And at the same time, as we've seen that growth in consumption, we've seen a pretty sharp decline in the household savings ratio, which fell from just over 11% in March to 8.7% in the June quarter. And what this shows is that while households on average are still saving, they're saving less. And we also know that they're impacted by the rising cost of living and the fact that their real wages are falling as a consequence of that. Net exports contributed 1 percentage point to real GDP this quarter as exports recovered and imports slowed. Mining and agriculture picked up because those severe weather conditions passed and also because they were able to respond to the really strong global demand for energy following those pretty extreme disruptions to Russian gas supplies to Europe. So there are some encouraging aspects of these results, but we can't pretend away or paper over the real and growing challenges in the economy that the national accounts also make clear. A weak investment in dwelling and engineering construction shows the impact of skills shortages and capacity constraints in our economy. Dwelling investment fell by 2.9% in the June quarter to be 4.6% lower over the year. This was a bit weaker than people expected, given we've got that large pipeline of work in the sector, but it does reflect the fact that we've got quite acute labour and supply chain pressures and that the sector is under considerable financial strain from high inflation in input costs. New engineering construction also fell in the June quarter to be 6.6% lower over the year as well. We also see in these numbers even more evidence, not that Australians around the kitchen table needed it, of the significant cost of living pressures that are impacting Australian households. We saw company profits reach record highs as a percentage of GDP, but real household disposable incomes fell for the third consecutive quarter by 0.5% in the June quarter. And while there are some welcome and encouraging signs that nominal wages are starting to pick up, there is no existing measure of wages growth that tells us anything other than real wages are still falling, given the high and rising inflation that we confront in our economy. Now, a number of the pressures, as I said, on the economy have grown since the June quarter, and so they're not completely captured in the data that the ABS has released today. For example, we've seen since then another 1.5% increase in interest rates. Households are paying more for their energy bills, and that is a consequence, I think, of some long-standing failures in energy. Prices are expected to increase further before they come down, and you all know that we're forecasting, or Treasury's forecasting, CPI to peak at 7.75% towards the end of the year. We've also seen a deterioration in the global situation. We've seen some of the concerns and pressures that we're monitoring in the global economy intensify in recent months. We've had negative growth in the US and UK. We've had extended lockdowns in China. We've got concerns about the ongoing impact of higher energy prices and interest rates on global growth as well. We've got those global supply chain disruptions and capacity constraints in the global economy, obviously, but also here at home, and that's putting pressure on our economy as well. Now, when it comes to the budget, the story is a bit similar to what's happening in the economy. We've got temporary factors which are boosting revenue in the short term, but other issues which are creating more substantial pressures that will be felt for far longer. High commodity prices have led to record high terms of trade in the quarter, but we can't rely on these high prices persisting. Commodity prices have come off their peaks. Just one example, since the end of the June quarter, the iron ore price, the spot price, has come off 19% in the couple of months since the end of the quarter that we're talking about today. There are also some substantial short, medium and long-term pressures on our budget as well. The Finance Minister was talking about these this morning. We've got the higher cost of servicing the debt that we've inherited. We've got additional COVID-related spending and hidden cost blowouts in that area. We've got significant spending growth in areas like the NDIS, aged care, healthcare and defence as well. And all of that obviously has implications for our budget. Despite some of the issues and challenges that we are being buffeted by, I still think there is substantial cause for us to be confident about the future of our economy. And I'm equally confident that the government has the right economic plan, which is specifically geared towards these challenges that I've run through today. We're doing what we can to ease the skills and labour shortages, to ease the cost of living where we responsibly can, and to get wages moving again. We made some really important progress, as you know, at the Jobs and Skills Summit last week, 36 concrete outcomes, including those investments in skills and housing, getting migration right, a commitment to fix the broken bargaining system as well. Now, we're not naive about the scale of these challenges, and we've approached the Australian people in a spirit of bluntness and frankness and candour in saying a lot of these challenges can't be fixed overnight. There's not a switch that we can flick to make cost of living pressures go away overnight or to make real wages grow again. But we've begun the important work bringing people together around these big economic challenges to see what we can achieve together to take some of the pressure off Australians and take some of the pressure off their economy as well. So these numbers today are new numbers, but they're telling a story which is now pretty familiar to us. A growing economy, but we want to see more Australians benefit from that growth. Different pressures are hitting the economy, but our future is still packed with potential. We've got an economy which has been made vulnerable by a wasted decade, and the task of the budget, the task of the government, is to make our economy and our budget more resilient into the future as well. We're now in the home stretch when it comes to budget preparation. I think 7 weeks yesterday until the budget is handed down. We're obviously meeting the Expenditure Review Committee for some hours, including late into last night. And that's important because budgets at their core are about weighing up competing priorities. The Prime Minister and the Finance Minister in the last couple of days have been upfront with the Australian people about the challenges we face in the budget. We will do the right and responsible thing, and that means doing what we can to responsibly ease people's cost of living pressures. It means dealing with the issues in supply chains which are holding our economy back, and it means beginning to deal with the legacy of rorts and waste, which has been a feature of our budgets for too long.